Welcome to the CFA Level 1 Practice Test 1. Domain, Equity Investments. Part 2. A fundamental assumption underlying the dividend discount model, DDM, for equity valuation is that A. A company will always pay dividends. B. Dividends will grow at a constant rate indefinitely. C. The intrinsic value of a stock is the present value of its expected future dividends. D. None of the above. Answer is C. The intrinsic value of a stock is the present value of its expected future dividends. An analyst's view on the statement about goodwill impairment charge being a technical entry not reflecting management's capabilities or future prospects is A. Accurate, as impairments are non-cash and often reversed in subsequent periods. B. Inaccurate, as impairments can signal flawed acquisition strategies and potentially weaker future cash flows. C. Partially accurate, because while non-cash, it mandates a downward revision of all future earnings forecasts. D. None of the above. Answer is B. Impairments signal flawed acquisition strategies and potentially weaker future cash flows, not just technical accounting entries. What is the free cash flow to equity, FCFE, for Alpha Corporation given its financial data for the year? A. $360 million. B. $370 million. C. $410 million. D. None of the above. Answer is C. $410 million is the FCFE, computed as net income plus non-cash charges minus fixed capital investment and working capital investment plus net borrowing. Why is the share price of a REIT likely to decline after a geopolitical destabilization in the country where it holds properties? A. Expected decrease in future rental income from its properties. B. Increase in the risk premium component of the discount rate. C. Temporary suspension of trading for securities in that country. D. None of the above. Answer is B. Market demands a higher risk premium reflecting increased uncertainty, increasing the discount rate and lowering present value. The statement, the option to make follow-on investments if an initial project proves successful, is a timing option is A. Accurate. B. Inaccurate, as this describes a growth option. C. Inaccurate, as this describes an abandonment option. D. None of the above. Answer is B. This option is a growth option, allowing further investments based on success, not a timing option. Calculate the free cash flow to equity, FCFE, for a company with net income 500 M, depreciation 100 M, capital expenditures 150 M, working capital investment 30 M, debt issued 80 M, debt repaid 50 M. A. $390 million. B. $450 million. C. $420 million. D. None of the above. Answer is B. FCFE equals net income plus depreciation, capital expenditures, working capital investment plus net borrowing equals $450 million. What distinguishes the risk profiles of preferred stock versus a long forward contract on common stock of the same company? A. Preferred stock subjects the investor to counterparty risk. B. The forward contract mainly involves dividend deferral risk. C. The forward contract exposes the investor to counterparty risk, not inherent in preferred stock. D. None of the above. Answer is C. Forward contracts have counterparty risk due to private agreements, unlike preferred stock ownership. Which valuation technique is most appropriate for assessing a commodity-sensitive company under different future states? A. Scenario analysis changing commodity prices, margins, and discount rates simultaneously. B. Stress test changing only the most impactful variable. C. Relative valuation using historical average P/E multiples. D. None of the above. Answer is A. Scenario analysis evaluates effects of simultaneous variable changes on valuation under plausible conditions. If long-term government bond yields fall significantly during a market downturn, how is equity valuation affected according to the Fed model, assuming earnings yields stay constant? A. Equities become less attractive relative to bonds. B. Relative attractiveness remains unchanged. C. Equities become more attractive relative to bonds. D. None of the above. Answer is C. Lower bond yields with constant equity earnings yields make equities appear more attractive than bonds. How does a sharp depreciation of country A's currency affect the USD value of a U.S. investor's holdings in a country A domiciled company? A. Increase. B. Remain unchanged. C. Decrease. D. None of the above. Answer is C. Currency depreciation reduces the USD value of holdings despite unchanged local stock price. Thank you for watching. For more learning videos and tutorials, subscribe to BSB Trainings.